What we want to see is a moderate jobs report, with the top line number coming in just shy of 200,000, wages around 3%, so maybe pulling back a little bit. And this should be good news for the market because it doesn't send the signal that the Fed needs to abruptly halt additional policy moves. That being said, we are seeing weakness bubbling underneath the surface, so we would expect the Fed to begin to taper back the pace of additional policy adjustments next year.
Who do you believe, though? Do you believe the market in the past week or two, or do you believe Jamie Dimon? To me, that's actually the real question, because he would suggest to you, in so many of these other interviews that Becky was doing yesterday, would suggest to you that the market's actually got it wrong, that actually the economy is stronger than we think.
Well, I think I believe the data. And the data says that we are starting to see weakness coming in particularly interest rate sensitive sectors like the housing market, like autos. We're starting to see the consumer pull back a little bit with the holiday season, maybe not quite as robust as some of the earlier forecasts. We're seeing business investment start to moderate, and that, to me, is really the telltale sign that we are going to see a much slower overall economic pace as we look out over the next 12 to 18 months.
Keith, which side of this world are you buying?
Well, we're of the opinion that we'll see some slowdown next year. We're not going to stay at a 3% real growth pace, but we think you can still settle into a 2.5%, which would be trend. If there's a surprise, we think the surprise will be actually faster growth, not slower growth.
Right.
So we think that right now, what we think the credit markets are telling us, because everyone got wound up because the 3 to 5 year and the 2 to 5 year inverted last week, which was the catalyst for that big sell-off. We think what that's saying is not so much that the economy is going to really dramatically drop off, but that the Fed has already gotten rates to where they need to be, especially with inflation rolling over. And what we need to see is the Fed start to taper off.
How much do you calculate the China potential trade war in terms of the way you're thinking about what may or may not be happening in terms of a slowdown, if you think that's real?
Well, I think the realized tariffs that we've seen thus far have shaved off about 0.2 of a percentage point from top-line GDP. But I think there is a real concern that if we continue down this ugly slope to an outright trade war, with additional levies on the already tariffs placed on $200 billion, more tariffs on the remaining balance, we could be talking about shaving off closer to 0.5 percentage point from top-line GDP. So I think that also is starting to filter into expectations and maybe exacerbating some of that downward pressure.
Keith, the idea that maybe we're going to get the slowdown, maybe the Fed has already kind of gotten most of its work done, has been one theme that's been bothering the markets. A lot of others, too. Obviously, we don't know what earnings estimates are going to be for 2019. Oil has been collapsing. So you've had all these things together, plus these big growth stocks that drove things for so long quickly went in reverse. So where does that leave us with the markets right now? They're about flat for the year in terms of the S&P 500. What have we priced in? Where do you think the opportunity is?
Yeah, no, Michael, look, it's a good point. There's, we're focused on a couple of things that are kind of the big looming issues right now. But, Europe's a big issue, too, right? There's a lot of things going on. We got Brexit with no clear exit strategy yet. Germany actually had the third quarter negative growth. So there are issues out there, but we think when you put it all together, we're still seeing actually a very healthy consumer. We look at the Bank of America numbers, credit card, debit card. We think they're going to continue to stay strong. We think unemployment comes down. The key will be, in the point about the trade war, what impact does it have on CEO confidence? Because if business confidence starts to wane, that'll show up in returning capital to shareholders. That'll turn up in capital spending. But when we put it all together, Michael, we think that next year, again, we're going to be okay. We're going to start to see.
So does the stock market overshot a little bit to the downside or no?
So we think we'll see 5% earnings growth next year. And if we see 5% earnings growth with the stock market below 2,700 on the S&P, we think you can see a reasonable return next year.